All right, next we're going to look at how we can record those transactions in a journal, and then we're going to learn how to post it into a ledger. All right, so in the accounting process, you're going to first look at the transaction. We're going to be identifying the source documents, figure out the documentation, what it tells us. Then we're going to analyze that transaction using that source document. We're going to be using the accounting equation, determining whether it's an asset, a liability, or a type of equity account. Then we're going to be recording it in our journal entry. And then once we're done that, we're going to post it into the ledger so we can see the balances in the individual accounts. All right, so here's an example of what a general journal transaction looks like. It has all the formatting that we need to have. So it says on the left side, we have our transaction date. So we see December 1st, 2019 is up at the top. On the inside, we see that we have two different accounts, right? We have cash that's on the left, capital on the right. The reason one is on the left is because we're going to put the debits on the left. We're going to indent and put the credit on the right. So that's why you see that indentation there. And you'll also see the amounts, the dollar amounts of the debits and the credits. So debits are listed in the debit column, credits are listed in the credit column. And then the last thing we see is an explanation. You may not be required to do an explanation in every transaction, but it at least helps you just kind of see what happened. So in this example here, the owner of the business contributed $30,000 cash to start the business. So we had to figure out, how do we get those pieces? So the date's important when recording our general journal transactions, and it's recorded on the left side. Then we identify the accounts that we are going to be using in that transaction. The cash account is an asset that has increased. We show increases in asset accounts with a debit to that account. Capital also increased, and we show an increase to equity accounts with a credit. So debits are always going to be listed first, followed by the credits that are slightly indented below the debits to separate out the two. The dollar amount is placed in the appropriate debit or credit column, and in this case the amount was $30,000, so we place $30,000 in the debit side, $30,000 in the credit side. And then again, the last thing we're going to do is put a brief description of what happened. So here we put that we received an investment by the owner. The explanation is indented just a little bit to help to make sure it's not confusing with the accounts, and it's often italicized, so it's easy to recognize. All right, so again, I said T accounts are something that we're going to use just for our learning process. So they're good illustrations while we're learning, but what we would actually use is called a 4-column ledger account or a balance column ledger account. And what you see here is it's going to be similar to a T account in that it has columns for debits and credits. It's different because it includes the transaction date and explanation columns. So it has a column with the balance of the account after each entry is recorded, which is good to know. We want to know how much cash we have after every entry. We want to make sure we don't overspend, right? So the cash account was debited for $30,000 and gave us a $30,000 balance. In the next transaction, it was credited for $2,500, which reduced the balance down to $27,500. Then on December 3rd, it was credited again, this time for $26,000, and its debit balance was then reduced down to $1,500. It was debited on December 10th, which increased the balance to $5,700. And that's how we would do the 4-column ledger account. All right, so when we talk about posting. So posting is the process of transferring the information from our journal into our ledger. So there are 4 steps in the posting process. First, we're going to identify the debit account in the ledger. We're going to enter the date, the journal page, the amount, and the balance. So that's what we can see here. The journal page, that's that G1, that post reference G1. And then we're going to enter the debit account number from the ledger in the post reference column from the journal. So that account that we're posting to, account number 101, is going up here into the post reference column in the journal 101 to show we posted that amount to account number 101. Same thing with the other one, the 301. The credit went to account 301, the capital account. So we're going to identify the debit and the credit, post them to the appropriate area, and make sure we note where we posted it in both the journal and also in the ledger. All right, so let's look at these, how we're going to see the transactions and what they look like. So the examples they're going to use here are the same examples we saw in chapter 1 when we were just identifying what accounts. Now we're going to see those accounts put into a journal entry format. So we have fast forward receiving $30,000 cash from Chaz Taylor as an owner contribution. So in chapter 1 we analyzed it and we said that cash increased $30,000 and capital increased. Now we're going to apply those rules for debits and credits to make that into a journal entry. So we record the information in the general journal with a debit increase to cash and a credit an increase to capital. Notice that the account number for the cash account is 101 and capital is 301. We're going to post the information in the journal to the general ledger, and we're going to use a T account to accomplish this. So that's what you see over here to the right. You see T accounts, just again for illustration purposes to show what we're doing. So we're posting that debit to the left side, the credit to the right side. The next transaction was to purchase supplies for cash. So our cash went down because we paid cash for supplies. Supplies went up because we got supplies. So if we look at that, we have exchanged one asset, cash, for another asset, supplies. So the cash account is going to decrease and the supplies account is going to increase. If we do the general journal entry to record that, we're going to increase supplies account with a debit and decrease the asset account, cash, with a credit. Then we're going to post those amounts into the appropriate T accounts. So we see here that we posted a debit to supplies on the left side of the T account and a credit to cash on the right side of the T account. If we look at our next transaction, we can see that we have a purchase of equipment for cash. So again, we are exchanging two assets. We're getting we're getting equipment and paying out cash. So the cash account will decrease and the equipment account is going to increase. It's going to look similar to the one we just did. So we increase the equipment account with a debit and we decrease the asset account with a credit. Then we're going to post those amounts into the appropriate T accounts. All right, looking at the next one, we have a purchase of supplies on credit. So again, in chapter 1, we did steps 1 and 2. Now we're just doing step 3. So we had an increase of supplies and we increased accounts payable because we're going to pay it later. So the supplies account and asset is going to increase and the liability account, accounts payable, is going to increase. We increase the supplies account with a debit and increase the liability account, accounts payable, with a credit. Then we're going to post a transaction. The ledger account for supplies is increased by $7,100. So that is placed on the debit side of the account or the left side. The accounts payable account or a liability increased by the same amount. We place it on the credit side of the general ledger. Let's look at our next transaction. The next one, we're providing services for cash. So we analyzed before in chapter 1 that we had revenue that we earned and they paid us cash up front. So now we're going to look at the rules for that. We're providing consulting services and collecting to $4,200. The asset account cash increased by $4,200 and the equity account consulting revenue increased by the same amount. If we look at the journal entry, then we're going to increase the cash account with a debit. We're going to increase revenue, the consulting revenue, with a credit. Then we're going to post them to the appropriate sides. You'll see that cash is starting to have several transactions. We'll be able to figure out the balance when we're done posting all the transactions into the cash account. If we look at transaction 6, we can see that we had $1,000 that we paid out for December rent. So we had a rent expense and our cash decreased. So the asset account cash decreased by $1,000 and the equity account rent expense increased by the same amount. We decrease the cash account with a credit and increase the expense account with a debit. So if we post those transactions, we're going to see that rent expense is posted on the left side as a debit and the reduction to cash is going to be posted on the right side as a credit. Then if we look at transaction number 7, we paid $700 cash for employees' salaries. We analyzed that the cash account cash decreased by $700 and the equity account salaries expense increased by the same amount. On our journal entry, we're going to decrease the cash account with a credit and we're going to increase the salaries expense account with a debit. Then we're going to post those into the respective T accounts. When we look at transaction 8, we are providing consulting and rental services on credit. So we provided two different kind, and the customer is billed for the total amount. So the customer is not paying us up front. So that means we're going to have an accounts receivable. Sorry, I skipped. So for this one, the asset account, accounts receivable, increased by $1,900, the total of the revenue. The equity account, consulting revenue, increased by $1,600, the amount we earned for consulting, and the rental revenue increased by $300, the amount we earned for rentals. We're going to increase the accounts receivable account with a debit and increase the two revenue accounts with a credit. This is called a compound journal entry, which affects 3 or more accounts. So we still have debits equaling total credits, $1,900 on both sides, but we can see that we had 1 debit and 2 credits. That's okay. We just have to make sure that our debits and credits equal. We can do compound journal entries. All right, for our next one, we received $1,900 cash from the client that we billed in transaction 8. So the transaction is going to increase the cash account and it's going to decrease that accounts receivable. So they're paying us what they owe us. So we increase the cash account with a debit. We decrease the accounts receivable with a credit for $1,900. We're going to post those amounts to the respective T account side. Debits on the left, credits on the right. Then we're going to look at transaction 10. It says a partial payment of accounts payable. So Fast Forward is paying $900 cash towards the payable amount that we created in transaction 4. So this transaction is going to decrease the cash account because we're paying out cash, and it's going to decrease that accounts payable, the amount that we owe them, by the amount we're paying, which is $900. So to decrease the cash account, we're going to credit cash. To decrease accounts payable, we're going to debit accounts payable for $900. Then again, we're going to post the respective amounts to the T accounts. Transaction 11, we have the owner withdrawing $200 from the company for personal use. That transaction is going to decrease the cash because they're pulling cash out of the company, and it's going to increase withdrawals by $200. So to decrease the cash account, we're going to credit. To increase withdrawals, we're going to debit, both for $200. Then we're going to post the debits to the left, the credits on the right. The next one, we have number 12, receipt of cash for future services. So we're getting $3,000 cash in advance for providing consulting services. It's going to require an increase to the cash account, and then we're going to use another liability account because we're getting the cash up front, but we haven't earned it. So we can't recognize this as revenue yet because we haven't provided the service yet. It's in advance. So anytime it's in advance, we're going to use that new account called unearned consulting revenue. It's a liability. So we're going to increase the cash account with a debit, and we're going to increase the unearned consulting revenue account for $3,000 by using a credit. Then we're going to post those. Remember that unearned consulting revenue is not a revenue account. It is a liability account because we owe it back to them if we don't finish that job. We haven't earned it until we've finished the job. All right, the next one is insurance, paying cash for future insurance coverage. This is where we're going to look at a prepaid. So we paid $2,400 cash for a 24-month insurance policy. The transaction will decrease the cash account, and it's going to increase our new account called prepaid insurance by $2,400. So we're going to decrease the cash account with a credit. We're going to increase prepaid insurance because it's an asset with a debit. Then we're going to post them respectively just like we have. For paying supplies for cash, we're going to increase our supply account with a debit, decrease our cash account with a credit. If we are paying for expenses in cash, we're going to debit our expenses and credit cash. So this one we paid $305 for utilities expense. We're going to decrease the cash account with a credit. We're going to increase the expense account with a debit, and then we will post the appropriate amounts to the T accounts. The last transaction is just showing us that we have a payment of expense in cash. So again, we have a salaries expense. Salaries expense is increasing, so we're going to debit. Cash is decreasing, so we're going to credit. The next slide shows us a summary of those transactions posted into the ledger and allows us to see the balances in each of the accounts after doing that. So this is where we're going to stop this video, and we will continue for part 3, looking at what we call a trial balance.